Good afternoon, and welcome to the Quarles and Brady Business Law Training Session titled Market Turmoil in D&O Insurance, and Is Your Company Protected from Cyber Risk? I'm Kim Mahan, a partner in the Business Law Group in Chicago. Before we begin today's presentation, we would like to invite you to join us on May 14th for our program on bankruptcy trends. As always, we have a few housekeeping items to review. For CLE credit, for our in-person guests, please fill out the CLE sign-in sheet located at the registration table before you leave today. For our webinar guests, please email the CLE form located at the back of the PDF materials to make sure the speaker receives the message. Also, for our webinar participants, we have muted all phone lines and participants are in a listen-only mode. A survey will be emailed to you after the program. Please be aware that this presentation is being recorded. And now I would like to introduce today's speakers from Lockton Companies. Chris Casper brings over 30 years of experience with directors and officers liability, employment practices liability, and various lines of errors and omissions coverage, including privacy and network security, and lawyers professional. Matt DeNazari is an insurance professional who finds solutions to complex coverage issues through program structure and corporate analysis. Matt has extensive experience assisting companies of all sizes and in various industries. He has experience advising boards of directors and executive management in purchasing appropriate D&O coverage, CFOs in finding insurance liquidity, strategy implementation, and advising on IPO transactions. Our third presenter is Riley Brandt, who is an account manager in the Lockton Cyber Technology practice. Riley assists in the day-to-day handling of accounts, including providing applications, contract review, binder review, and policy review, as well as technical experience. And now I'll turn it over to Chris.
Thanks, Kim. Can everybody hear me okay? Thanks to Quarles and Brady for having us into your home today. Thanks for showing up in the room, and those of you who are here on video conferencing. My job is relatively easy today. I get to tee up the experts and then talk a little bit about what I call the tale of two markets, sort of a history lesson to give you some context on where these lines of insurance started, how they progressed, and where they are today. Matt's going to talk about directors and officers liability. The market there is like we've never seen before. It's like somebody flipped a switch and we went from soft market to hard market. There was no transition. It was literally overnight, and we'll talk a little bit more about that when we get to it. Riley's going to talk about cyber. That market's a little better. There are some signs that that market too is about to change, and no, it's not the coronavirus. But there are some signs that pricing is starting to change, and we'll talk a little bit about that too. Before we begin, does anybody have questions that we can address up front, something that you wanted to talk about specifically? All right. Directors and officers liability and privacy. The D&O world has been around for about 30 plus years, maybe even 35. Cyber is about half of that, so call it 15 or so. We'll start with D&O. Back in the early days, or in the beginning, the underwriting process was relatively unsophisticated. Everybody got the same coverage. Everybody pretty much got the same price relative to revenue or relative to total assets. And for a while, everybody just got the standard product. As the As the product started to mature, carriers started to compete with price and coverage. They got more sophisticated in the way they did their underwriting. They could determine between a good risk and a bad risk. To give you an example, in the beginning, a D&O policy did just what it says. It covered the directors and officers. It did not cover the entity. And routinely, we had claims that included both individuals and the entity. So right off the bat, you had an allocation issue, a fight, if you will, with your insurance carrier. The last thing you want to do during a D&O claim is to be fighting with your insurance carrier. As the market matured, they competed with price and coverage. Prices kept going down and down and down. There were a few market cycles, so think 2008 financial crisis, a little bump in the road, but almost overnight the competition started back up again. Capacity was at an all-time high, coverage was expanding, and prices were going down. The point I want to make with this is the market disruptions in the past were event-driven. Again, think 2008 financial crisis. The disruption that we're seeing today is market-driven. Claims are at a point where D&O carriers are no longer making money. They're certainly not making money in the markets. So the only way to fix that is to reduce capacity and increase prices. And again, Matt is going to talk about that in more detail. The cyber side is a little different. We're either still in the beginning or entering phase 2, or a mature market. They still compete on price and they still compete on coverage. As I said before, it's slowly starting to change. What will trigger the flip of the switch? We think that some sort of systemic claim, perhaps the coronavirus, will cause the cyber market to start to harden as well. A good example of that is the Blue Cross Blue Shield network. Anthem had a breach, finally, was that 5 years ago? 5 or 6 years ago. And since the Blues are all interconnected, a breach at one overlapped into some of the others. So the cyber insurance providers ran for the hills. So we had Blues cyber programs whose primary market non-renewed, whose excess market non-renewed, and their prices in some cases tripled. Fast forward to today, those prices are already below where they were before the Anthem breach. So the disruption was an event, right? It was the Anthem breach. And those two distinctions are important. If it's a market event, it's going to stick around a long time. That's what we think in the D&O market. If it's an event-driven disruption, over time, a year or so, maybe 2 years, things get back to normal. Any questions on any of that before I turn it over to Matt? Matthew?
Thanks, Chris. So the first slide here that I want to discuss, and I'm going to be relatively brief on this slide because what I've found is when I speak to this too much, we'll be out of time. So we can refer back to this slide if you have it in front of you, or I can flip back a couple of times. It's a good illustration of what's going on in the market and kind of dovetails with some of Chris's comments that he made earlier. So the graph on the left here, or the bar chart, is really a Section 11, 33 Act claims, 34 Act claims that have been filed over the past 15 years. 10 years. The graph on the right is 15 years. And so you'll see the natural lift that is occurring in the marketplace through sheer number of claims filed. The graph on the right is a percentage of filings. So as insurance companies start to price risk for clients of yours, and law firms would be included in this as well, they typically, on average, are estimating about a 2.9% average number of filings for securities class actions and other D&O claims. That's a long-term average between 2017. If you take 2017 out, because you can start to see that big ramp up in 2017, it's actually about 2.2 to 2.3%. And so it just speaks to how underpriced this book is. Now, what's driving some of this, we'll talk a little bit about it in the next couple of slides, but what really is driving the percentage increase is twofold. One, there's just less public companies out there. The rise of PE and VC firms have sucked up a lot of what traditional ways of getting capital would have been, which would have been to IPO, and those IPOs have been put off for quite some time, leading to a higher percent chance or less shallower pool of public companies. You now have an 8.6% chance, or approximately 1 out of every 11 public companies will experience a D&O suit in any given year. That number is astronomically high and certainly much higher than what insurers are charging you for historically. The other thing that has gone on is you do have parallel filings, which we'll talk about in the coming slides. And so you have the rise of M&A litigation. And what that is essentially, if you're a public company and you acquire another public company, you have an all but 100% chance of having a D&O lawsuit because of that. Why is that the case? Well, because it's easy money for the plaintiff's bar. These guys can come in, they can file a lawsuit. Of course, they'll allege that the directors and officers didn't do their due diligence. And on one side, you'll have a lawsuit saying you didn't get paid enough for it, for the company. And on the other side, they're saying that, either we didn't get paid enough or they didn't offer us enough money and we didn't do a due diligence in correlation to that. So this takes a lot of money to defend, and more money than it has in the past. And so the retentions in insurance are not designed, historically anyway, they're being closer aligned with this now, but they're not designed to cover all of those fees. The expense has grown exponentially in that realm. So with that, you can see that there's a high number of those claims filed on a yearly basis for the past 4 years. That trend is continuing for two reasons. One, it is, like I alluded to before, easy money. And two, the deal can't close until this litigation is taken care of. The third reason is because insurance covers it. So you're going to get paid. You've got to check. Let's close this deal. Let's get the acquisition done like we plan to do. And there goes $3 to $5 million. So that is all eroding the insurance, what's underneath the insurance layers.
I'm going to interrupt 1 second. I want to make sure Matt's point is clear. He's talking about bump up claims. So you didn't get enough money for our company when you sold it, and traditionally those bump up claims cost $800,000 to $1 million to make them go away. So it was within the retention or the deductible of these D&O policies. So carriers weren't paying out on those fairly frequent claims. Now they're much larger, talk 5 million, 6 million, 8 million. So they're going through the retentions, and carriers are actually paying out significant dollars on what used to be nuisance claims, and now they're a bit more than just nuisance.
No. So looking at the next slide here is a couple of drivers that I'd like to cover on this, and this is a lot of words, and so I apologize for that in advance. But we covered the merger objection suits. There's emerging law firms traditionally, at least from what people tell me, that the law firms were bringing cases that they had a higher degree of chance of winning. You've got 3 firms in particular over the past 3 years that have filed close to between 43 and 60% of all D&O cases out there, Rosen, Pomerantz, and Glancy. These guys have a lower hit rate. They'll sue anything that moves, and they've had some huge payouts, don't get me wrong, but it just ticks up the sheer number of claims. Each of these, the insurers have to defend, so it's going to cost money. If you're in these top 3 industries, which remained over the past 3 to 5 years, life sciences, technology, and financial services continue to be the main drivers for that result in securities class actions. SEC enforcement and whistleblower activity continue to drive, I think, some of the payouts for insurance, but also they've been big wins for the Justice Department. mean, the SEC enforcement actions continue to rise, and the whistleblower has been a huge success, throughout the years. As of last year, it had $168 million in total payouts, and those continue. The other thing I would say is that when Jay Clayton took over, there was questions about where his allegiances were and his alliances and how forcefully he would go after some of these companies. One thing that has held throughout his tenure and continues to be is that he has continued to say he will hold directors and officers personally accountable for their actions. And so that has driven Side A insurance, which we can talk about in a little bit, derivative actions, and the way that we structure policies to protect insureds, because he is following through on that. The last 2 points I would make on this slide is, one, claims allegations. Chris alluded to earlier about event-driven litigation, and it's really a phrase that's now coined and in use pretty often, because what we've moved to in D&O insurance is a risk from, when I had started about 17, 18 years ago, we were looking at, as a D&O underwriter, I would go through the 10Ks, 10Qs of a company, I'd talk to the management team, but we were really looking at financial GAAP violations. We were analyzing the company to make sure that when a dollar comes in the door, it's a smooth transition as possible till it leaves again or gets in the shareholders' hands. And so now what we've seen for the first time is this shift to where the term that is coined is event-driven litigation. As an underwriter now, I'm trying to establish that PG&E is, I'm looking out for wildfires. I'm, Boeing with some of the problems with the 737s that they've had. I mean, these all result in D&O claims to the board of directors. And as an underwriter, former underwriter, that's really, really hard in any given industry to try to underwrite to. And the long and short of insurance is, the simpler you can make it, the more transparent you can make the risk, the cheaper the insurance will be. And it's just caused the unknowns in any given scenario just cause a higher and a higher insurance rate. And so that is part of what's driving this, is that the Me Too movement, as you've seen, is also, people aren't underwriting CBS or Fox or any of these looking at trying to determine if there's sexual harassment allegations in your D&O policy. Like that, those are side claims that result from those events, but it's really hard to underwrite to that and 100 other scenarios that may come down the pike. The last thing I would say on this slide is 33 Act, Section 11 on the right side. The Cyan ruling continues to wreak havoc in the D&O industry, and what that is saying is, if you have an IPO, you are subject to 1933 Act, Section 11 litigation. And so the bar, the threshold to bring that is lower than it is your standard 34 Act or ongoing. I've been a public company forever, and I have existing shares that you bought and then sold. What the Cyan ruling changed was that you can bring these claims in state court. Traditionally, you were only allowed to bring these in federal court. Now that you can bring them in state court, what you have is insureds fighting a multi-front war. They're fighting, we have a large client in the state of Wisconsin that is fighting one of these 33 Act multi-front wars. And you've got the litigation rate. We're not even to motion to dismiss. We're just getting to the first mediation, and the litigation costs are close to exhausting the $10 million in insurance limits. Now, that is unheard of for any claim that has happened in the past, historically before the Cyan ruling. They're fighting federal cases, they're fighting state cases, and they're fighting derivative cases at the same time. And you can imagine how quickly these legal costs ramp up. They've got $1 million retention. So the stuff that traditionally $1 million retention got you to motion to dismiss, maybe 2.5. Now it's 5, 8, 9, 10, and all that just comes out of the primary. So the primary insurer is basically cutting a check and saying, good luck with the rest of this claim. I hope you settle it, but we're out. The next slide here goes through a number of risks that are out there for the threat environment and why things have increased. There's all kinds of different lawsuits that you can bring against companies, and I won't spend a lot of time because I don't have a lot of time, but on the left side of this column. The right side of the column, just want to point out and reiterate some of the things that we talked about earlier. Riley will touch on BIPA and GDPR and some of these other threat landscape environments that are hitting also the D&O policy. So what we're seeing is cyber claims that lead into D&O claims as well. He'll touch on Capital One and some of the threats that we face in that. But a couple things I just wanted to highlight out below the cybersecurity were duty of oversight. So Blue Bell, which if you've had, there's ice cream and a dairy manufacturer. This was one speaking to the difficulty that was just settled last year. All of these were just settled last year, and the difficulties of underwriting. So Blue Bell has, had I think it was Listeria or one of these outbreaks, product contamination outbreaks, and D&O lawsuits came as a result of that. And basically, they said that the board of directors did not do their due diligence. They knew about their alleging that they knew about this before, that there's product contamination, and the company was not prepared for an outbreak or protecting their products from the public. So, this is the kind of thing, the Me Too movement, and we talked a little bit about that, so we don't need to belabor the sexual harassment suits and everything going on there. But these companies are getting sued because of things that underwriters did not previously think was going to affect them. Even to climate change. So 3M, something called PFAS, which are polyfluorocarbon somethings that 3M makes. And the environmentalists came out and said, you guys have known for years that this is harmful to humans, and it's in all of your masks and other things that you guys make and distribute to the public, and therefore you guys have contributed to climate change and have hurt the environment, and therefore you guys need to pay. So PG&E was the wildfires that we paid for. These are the types of claims that are being brought against insureds that underwriters never anticipated when they originally wrote the policy. You all, I'm sure, are familiar with Wells Fargo and the derivatives that resulted from the bank accounts and the fake bank accounts that they were setting up. Another thing that, again, you wouldn't have thought to underwrite for as you were preparing for that underwriting meeting. So what does this all mean? I know that we talked originally on the first slide. You saw that escalation, and Chris's comments earlier. You've got to be saying, well, Matt, then why is this just happening now? Why did we spike? It seems like that seems to be a pretty progressive, albeit hockey stick-like curve, but a pretty progressive increase in claim notes. So the problem with insurance, I think, traditionally is that we don't know the price of our products, meaning the insurers don't know the price of the product when they sell it to you. I could sell you a piece of paper that says $10 million, and it could cost me every bit of $10 million, or it could cost me, standard monitoring fees and personnel fees, and it could cost you a couple thousand or something like that. You don't know, the insurers don't know how much their built-in cost of their product is. So when someone offers you a 10x of 20 for 100,000 and somebody else is doing it for 80, the guy offering it for 80 might be right. He might be wrong, and that could cost him 10 million. But the point is that when you have increasing claims activities, there's a lot of times where the insurers are saying, let's just wait and see what happens. Let's not overreact to this environment right now. I still don't want to lose this relationship. I want to keep it. I'll ride it down or keep it flat for a little bit. And so you see this quarter over quarter public company pricing trends. And you can say even into 2018, we're still at flat renewals, basically 2.6% renewals. And now you see an escalation because people were willing to stay and ride this out and call what 2017 and 2018 happened as an aberration and something that they didn't expect to see going forward. But now when you get into 2019 and the numbers are still the highest ever, they've all had to step back and say, all right, now, because these claims still haven't settled. And what it essentially, if I could give you a visual, it's like a tidal wave coming at the insurance companies here of unpaid, huge bank of unpaid claims that haven't worked through the legal system. And they're going to have a lot of payments coming up in the upcoming years. So now they've said, oh my God, we really are not charging for this, and we have to. they're no longer afraid because other insurance companies, even companies that were sucking up business if they'd moved before, are finally putting their foot in the ground and saying, you know what, we're digging our heels in. We're not going to undercut Chubb or AIG or one of these other carriers because I can't afford to do that either because I'm underpriced in my book. And so eventually, now it has come to a time when prices are spiking, and you can see 2019 Q4, 25.8 to 15% increases is the median. That's lapping a 2018 Q4 of 12 to 7%. So you're on top of 12% increases last year. Now you're at 25, and we are expecting that to continue due to this bank of claims and the current competitive environment that's out there. We won't camp out here for very long, but it's just the top carriers underwriting public company D&O. Most of these guys you've heard of. The Chubb, AIG, and XXL continue to be, and this premium, by the way, numbers are just locked in internal for a small cross section of our business over a small cross section of time. So this is not a whole market view here, but it gives you a point of, it is correct in that Chubb, AIG, and XL continue to be the top three writers of this. I believe XL now in this 2019 has now actually surpassed Chubb and AIG due to actions on their book, and they are now the number one D&O carrier out there. But it's a big distance between that and a big drop off between the rest of them. But the rest of them are just as active in the marketplace and digging their heels in just like everybody else for rate. And what you're also seeing here, the other point I would make is that a lot of these carriers are now pulling back on primary coverage. Many of these carriers are seeing the increases in rates, and they're just saying, look, if we get a D&O suit, our limit's gone. And therefore, we just have to look at everything as a limits loss on the primary. And if we can't get $300,000, $400,000, $500,000 for a primary 10, we're just not even willing to offer limits. Now, most primary 10s for normal industries are in the mid 200s, mid to low 200s, if not 350 max. So those numbers are way off from where people are used to pricing things, and therefore they're either completely out or you can drive a little competition. So the amount of primary business has gone down. The number of carriers you can access has gone down substantially. So what do we do? I don't want to be all doom and gloom, but 94% of my time has been doom and gloom. So I'll just end with this. I mean, the strategy here really as a business partner is to help our insureds manage this as best we can. There's no magic bullet that we have to, get you a 20% decrease. And if someone's coming to one of your clients and saying, oh, well, we can get you a 20% decrease, they're probably incorrect or something is drastically wrong or has drastically changed with that company. The landscape is just not there, and we don't win clients by coming in and saying, we're going to save you a bunch of money. While we do win clients day in and day out is through our process, which is a different way of doing business than we typically, than in a soft market or even many of our competitors do. It starts with, as I'm sure you guys focus a lot on, is knowing your client. You've got to know the ins and outs. You got to know their visions, their strategies, what they're trying to hit on. Is it cash flow? Are they debt laden? Are they trying to grow top line? And you need to leverage that to the marketplace. You need to know what to focus on a given insured, and you need to know what you can let go and just say, hey guys, we can either take an exclusion for this, or we can just move on. Major shareholder exclusions or other aspects of business that you can carve out and just say, look, we got to give that one to the street, and we'll continue to try to maximize our chances here. You need to tell their story well. And then from our standpoint, we've got relationships all over the world. We're a global company, and we need to leverage that as much as possible. We are accessing more and more markets than ever on each risk because you've got to have access to as much capital as possible to get a good outcome for your clients. The last thing is we spend a lot of time on data analytics, and really the point is we have benchmarking, which a lot of people spend a lot of time on trying to figure out, what other people buy, which can be important. But our focus a lot of times is not necessarily what other people buy, but because our clients are pretty unique, it's focusing on what you should buy and what in particular is is a securities class action going to cost you? That's the main driver for a D&O claim. And if you experience a securities class action, what is that going to cost you? And then let's cover, which many times is much different than what your benchmarking would say, your standard benchmarking. And so taking a deep dive with that, with what is called dynamic capital modeling, which we analyze each and every layer and make a determination as to whether or not it's worth self-insuring that layer or giving it to the market. It's a very, very tailored process that we drive down on each line of business that we're insuring for you to try to make sense that if you have 20 extra grand, do you spend it over here on product contamination, on property, on cyber, on D&O? So it's a very detailed process that we walk through with our clients to make sure you're managing as best you can your risk dollar. Now I'll turn it over to Chris, and he'll give you the scoop on private, which is a little bit more positive than mine, so I'll...
Actually, not much. Most of what Matt was talking about was public D&O, so think securities claims, large public companies. We wanted to have at least one slide on the private business because that world is somewhat similar, not quite as extreme, but it's not like it was 2 or 3 years ago. As I mentioned in the beginning, the D&O market, they were competing with price and coverage, expanding coverage instead of reducing price. And then everybody offered the same expanded coverage and they started to reduce prices more. What we're seeing now is just the opposite. Prices are going up, retentions are going up, and they're restricting coverage. Two of the main areas that are problematic for, we have a number of spirits companies, as I mentioned, we write a number of the blues. We have a number of clients where antitrust is a significant exposure. Many, if not all, let's just say many of the D&O carriers in the private space are now excluding antitrust entirely or significantly reducing the limits that they offered. So we just went through a renewal where we had a $10 million placement, included full antitrust coverage. The carrier reduced the antitrust coverage from 10 to 2.5 million and kept the price the same. So the last time I looked at that, it's four times the price for the same coverage. Entity coverage, there are a few markets that are starting to delete that coverage. To me, that is a significant issue, and it gets back to this, this allocation issue that I talked about at the beginning. When there is a lawsuit, it will certainly name individuals, and it will certainly name the entity. And right off the bat, you're going to have issues of what's covered and what's not. 90% of the claim, 10% of the claim. So if that happens with one of your clients, be sure that they have a predetermined allocation endorsement that predetermines when this happens, if both are named, what percentage of the claim is covered. And we would suggest it would need to be north of 80%. We'll see how the market plays out, but historically, that's how it works. I won't spend too much time on these others, but EPL is sort of the same. Retentions are going up, coverage is being restricted, wage and hour or other compliance-related exposures are being sublimited. There used to be a wage and hour, you could buy full limits wage and hour, that is no longer available. That segment of one of the carriers' business went out of business because of the claims activity. Social engineering, there's a distinction there. If somebody tricks you and has you send money, that's a crime exposure. And if somebody tricks one of your employees and they send data, that's a cyber exposure. There is some overlap, so you need to be careful that it's predetermined what policy would respond first or excess or which policies don't respond at all. And then finally, other areas like extortion. Cyber extortion is covered under the cyber policy, but you can also find that coverage under kidnap and ransom, under their extortion insuring agreement. Those loopholes are closing very quickly, so it's important that you understand or your clients understand what coverages are covered where and what the overlaps are and the necessary steps to make sure that those are handled properly. With that, I'll turn it over to Riley for a discussion on cyber. I think you have 10 minutes, buddy.
Yeah,
He's the fastest talker I know, so this will be fine. 10 minutes will be fine.
Yeah, so let's talk cyber. So thanks again for everybody joining, taking an hour out of your day here. 1 second. So yeah, so here's just a quick overview of Lockton Cyber Practice. We're 53 members globally. I sit in Chicago and work within the Chicago and Midwest series. So on my clients specifically, but we collaborate on everything in the marketplace, claims you're seeing, different cyber, what's going on in the threat environment as far as hackers go. So a lot of collaboration among the group. Last year was right around 225 million in gross written premium. And the final bullet here is coverage focused brokers. So as Chris mentioned in the beginning, it's a very immature insurance product, right? We think about property insurance, general liability, workers' compensation. They've been along for a very long time. A lot of data, right? Easy to underwrite, not easy to underwrite, but it's more predictable just due to claims experience. So with cyber, there's not much data. There's not much actuarial information going into it. So where we can differentiate ourselves from our competitors and really get, help a client with their unique risk is being coverage focused. So you think about traditional, traditional cyber exposure. We think about liability. It's really transitioned in the first party, and coverage has really expanded into areas such as supply chain and other areas that I'll touch on here in a minute. So, what's our process as we are evaluating a prospect, evaluating a client at renewal, having continued conversations with a client throughout the year? We established really a governance process. So, as you all may know, clients are navigating the cyber age, the digital age differently. Some are slower than others, faster than others. They might not understand their exposure. They might not understand, what happens if their systems go down for an extended period of time. So, kind of twofold with identifying their assets. First, I heard a fun fact or whatever. Data is now the most valuable asset in the world. I don't know if that's necessarily true or not, but think about all the decisions that everyone makes, right? It's based upon data. Companies make big decisions based upon data that they're given. And then two is just reliance on computer systems. So, I'm sure you guys are hosted on the cloud, right? So your cloud provider goes down, you can't really service your clients, you can't bill those hours. And then think about a manufacturer. Everything they do, from standard manufacturer, even some construction companies, goes through an ERP system. They're relying on it. ERP system goes down, they can't generate revenue, they can't operate at all, and there's reputational risk from that. So really, our job is to educate first. Before any insurance placement goes into place, any coverage goes into place, because you'd be surprised by the number of companies, large companies, even public companies, that don't purchase cyber insurance. So really, education of the product, education of their exposure, and their changing exposure. So really quickly before we move on here, my job is a broker, right? I'm the insurance guy who puts the policy in place. But with cyber, and as you all know, being in the privacy space, if you're taking a look through your website, being in the privacy space, you'll have some breach coach expertise, right? There's so much that goes into evaluating risk pre and post breach, tabletop exercises, facilitating those, creating an incident response plan, being involved in that, really learning about the client and how their systems will be impacted and what do they do when that bad day hits. So any questions there on the first slide here? I know I kind of threw a lot at you. I need to slow down, as Chris is going to tell me. So really quickly here, I'm going to jump back to this slide. This is just an outline of the boring coverages that we'll talk about over and over again within a cyber policy. So we'll jump back to that. We'll also jump back to this here really quickly. So first, a dumb guy like me, I wanted to, this really helped me understand why we are where we're at, I guess, in the technology age and how quickly these things are changing. So you see the picture of the Earth here we got the crust, mantle, outer core, inner core. So when the internet was created, this is what I was told, I guess. So it was really created to universities to share documents back and forth. It wasn't created they didn't think it would turn into what we have today, right? And how much change has taken place. What we have today, everything is through the internet. So how the internet was described to me, the infrastructure of the internet, think about the crust of the Earth, how thin that is compared to everything within the middle. So what you see on the internet when you're Googling anything or you're on Yahoo Finance, anything public facing like that, that's within that 4% crust. Also within that 4% crust is companies such as Lockton and you guys is your internet that's specific to your organization that only people within your organization can access. So within that 4% is public, and that the rest of it is open. So when everyone's always like, well, Why can they catch these bad guys? Why cannot the FBI do something about it? How are they not traceable? It's because of the other 96% that's just, out there. So that kind of helped me wrap my head around how are these bad guys getting away from it? How are they so, they're really innovative, right? They are coming up with new ways to, trick companies. And with that, what we're seeing really a ton, really on our small, if you think about my book of business within the Midwest, pretty small sample size of companies compared to the entire globe, right? Even on that book of business, we're seeing a ton of ransomware events, very impactful ransomware events. And the ransomware events, so one, I'm sure you guys are aware, but just in case, ransomware, what it does, however the hacker gets in the computer system, right? So someone clicks on a link just through a straight penetration through the infrastructure. Once they get the company's computer system, ransomware is deployed, and there's a bunch of different strands. So what it does just locks down your computer systems. You're unable to operate. You're unable to do anything to generate revenue. Like I said, from a manufacturer to a law firm to any professional services firm to a broker, you can't access your data. You can't service your clients. So once you're locked down, you'll be hit with the demand, and the demand will literally say right on the screen, pay me X amount in Bitcoin, and then we'll unlock your computer system. So, Bitcoin's trading at a pretty high penny, and hackers are starting to demand higher amounts. They're getting smarter. So they see a public company, they're able to get in their computer systems, and they're like, well, they're 1.2 billion in revenue. I think they'll pay $2 million worth of the demand. So you have a decision to make as a company. Either you pay the demand and trust that the decryption key will unlock the computer systems, get them back up and running normally, which hackers, they actually do. They get on the phone with these hackers, negotiate with them, try to talk the computer forensics firms that specialize with Bitcoin wallets, try to talk the hacker down from a high demand amount to a lower demand amount, and then they vet if the key is credible. So then key comes in, unlocks your computer systems. If you choose to not pay the demand, you normally restore from backup. So say a company restores every 8 hours, every day, once a week, depending on what their operations are, is how frequent they'll back up their data. If you choose to restore from backup, that's great. Offsite backup, not an internet connected backup. Hopefully you'll be back up and running soon. There can be issues with that, right? Software needs to be reinstalled. Hardware can be ruined. New strands of ransomware, hackers are sitting in the system. They're encrypting the backup. Then they're encrypting what you're working on that day, and then you hit the demand, you try to restore from backup, you have no choice, the data is lost. Also, really quickly here, data exfiltration. This is becoming, so the typical strands of ransomware is just that business interruption, that scary piece, right? You're down because of ransomware or you pay the large demand. With data exfiltration, we think about companies with actual data, right? Retailers, hospitals, anyone, insurance companies, anyone who has a vast amount of data, so personally identifiable information, payment card information. The new strands, you're locked down. You're not only locked down, okay, we can restore from backup. If you restore from backup, hacker can exfiltrate data, then it's posted on the black web, and then we have big class action lawsuit that follows, and go from there. So really quickly on the market update, the threat environment really leads to that, is the market update. So going to be a market shift. Like Chris mentioned, the pricing, it's market driven, competition driven. Claims haven't been coming in except for we think about the Target's Anthem breach. Now these first party claims, the ransomware events, and then obviously the big headline breaches, right? Marriott, Capital One, these high limit losses shake the market, but also those $2 million hits that insurance companies weren't really planning on paying. Underwriting is very evolving. They're starting to get hit on their book of business. So it's creating a market shift, kind of a quick market shift. So we'll probably see that continue, and you never know what's around the corner, right? So that leads to decreased capacity, so just less limits available out there. Don't need to touch on that too much, but we think about a Marriott or whoever who buys hundreds of millions of limits, that capacity shrinks up, not enough bang for their buck, higher up in an insurance limit tower. And then underwriting approach. This is interesting, and we deal with this here at Locked-In, and we'll get to a little bit of analytics later, but the underwriting approach is changing quickly by underwriters are externally scanning companies' computer-facing infrastructure or public-facing infrastructure, looking for vulnerabilities, looking for unpatched software that they can see from the public side of public-facing, and then they're underwriting to that. So it is an evolving underwriting process from just revenue, asking a few questions. Do you have an incident response plan? Do you patch every 30 days, what have you? So it's a really quickly, really fun, fun market to be in because it's changing. You see new things every day. So that's what we're seeing from like the threat environment side and a little bit of a market update. So if we back up here really quickly and the evolution of coverage. So kind of get into the details of what a cyber insurance policy can do for an organization. So you think cyber insurance, you think liability, liability, liability. And that is true for most cases. But if we think about organizations, the vast majority of organizations who don't have our data aggregators, aren't Target, aren't Marriott, who have a lot of personally identifiable information, personal health information, they're operation or manufacturing or what have you, where there's not a lot of data, they still have a massive cyber exposure. So it's gone from third parties, so those class action lawsuits, PCI lawsuits from the card brands, and media is still there, but we've gone from that third party piece really to the first party. And as I mentioned, the business operations that can just really be shut down, ruined for 30 days, 60 days, lots of customers. All these first party coverage, reimbursement coverages are available in the marketplace and really relatable to you all here, those breach response costs. And really this is where, privacy attorneys and breach coaches play the biggest role and pull clients out of a really tough situation where they're not prepared. Say they're not prepared, breach takes place, they're locked down. Privacy attorney, computer forensics firms, all the billable hours from that will be covered under their cyber policy. So educating my clients on what the policies can do kind of surprises them sometimes when they've been heard liability from information for so many years. Like, we don't have any information. I'm like, well, you're right, you don't, but you have all this exposure. So, breach response cost, what falls in that, like I mentioned, privacy attorney, computer forensics firms, public relations. If we think about a Marriott situation where you got to notify the public, try to, knock down that reputational loss that ensues from it, that stock drop, and then cyber extortion. So the policies will pay, kind of get a bad reputation, and the cyber insurance is in a way for actually paying these demands. I don't know if it's true or not, but that's the reason people come up with is why hackers are demanding these higher amounts. They know companies have a policy that will respond. I don't know if that's true or not, but the insurance companies, they won't have a say in it, right? It's a business decision. The good news is if they pay or don't pay. If they don't pay, this business interruption coverage is there. This operational risk coverage is there, and the coverage really expanded. And that's the reason that they're slowly starting to not broaden coverage as much, and watch the amount of limits they're deploying out there, because I mentioned that market shift. So really on first party, so every organization has an exposure. So at Lockton, we kind of came up with here a lot of information on this wheel, but really what the wheel is, yet again, splitting the coverages. So we got our first party and third party, and just showing that, like, look, cyber, so first of all, peril in the insurance world, we think fire, we think wind, we think snowstorm, whatever have you. So fire ruins a building, that's the peril. So cyber is a peril. Cyber can, cyber crosses most lines of coverage. We think property, and it's just involved with every piece of your business. So we need to look at it as a risk that affects everything you do. So what this wheel does is just a good graphical depiction of the coverages available in the marketplace and where there can be overlap. And we're here to guide a client through that, right? Alrighty. So as I mentioned, the first party piece of it, the operational risk and the broadness of coverage and how the coverage has evolved. So we got business interruption on the left here, and then we'll touch on kind of the far-fetched stuff that underwriters are kind of worried about, companies might be thinking about. So on the left side here, business interruption, a couple of different triggers. Here's what they are on the bullets. So the ones I'll touch on briefly here. So we have our direct business interruptions. We think security failure and system failure. So we think ransomware on a computer system at that company's site. They're locked down, so it's a malicious attack. There's also system failure coverage. So if you rely on AWS or any cloud provider, they go down as a result of a cyber event, then there's contingent business interruption. So if they're down, you're not gonna be able to operate because you can't access the cloud because your cloud provider is down, your business interruption loss that ensues. The newer coverage that really our manufacturers or non-traditional buyers like is the supply chain coverage. So Chris mentioned the spirits companies that we have earlier. They might rely on one single source provider of a bottle, of a can. So if that bottle supplier goes down, and as a result, liquor company X can't manufacture, can't distribute, can't put their product into that bottle, they've experienced business interruption, extends to that third party. So the coverage is really evolving, and it is, it's going to continue to evolve, and that's why also the underwriters are watching this aggregation problem, right? We think Amazon Web Services goes down. It's far-fetched, right? They have 16 zones, duplication, what have you, but if they go down, one, we got a big U.S. economy problem, which we might have now with the coronavirus, I guess, but if they go down, every business is going to be affected by that. Insurance companies are going to pay losses that could be, wipe out their entire book of business. So that's the issue with cyber. It's continually evolving, continually changing. The threats are unknown and will continue to change. And then real quickly, the far-fetched examples, right? Property damage or bodily injury ensuing from a cyber event. So the first one I have here is German steel mill. If you heard of NotPetya, the former ransomware was deployed a couple of years ago, NotPetya affected a lot of organizations in Europe. It was suspected to be a nation-state attack. So NotPetya affected a German steel mill. The hackers were able to get into the German steel mill, crank up the furnace on it. So the German steel mill had no control over the furnace. The furnace was cranked up, controlled by the hackers, led to a massive explosion, hundreds of millions of dollars worth of property damage. The cyber event was the trigger, right? So it's going into some real life stuff, not just non-physical were shut down, to actual property damage. Again, kind of far-fetched, but we think of Internet of Things devices, right? One of the terrible terrorist attack, nation-state attack examples that the government has been worried about. We think about people who have diabetes, have a pump on them at all times. It's connected to the internet. If nation-state attack is able to get into the computer infrastructure, they could dump insulin for everyone that has that pump, resulting in a massive amount of deaths at once. So, not the scary or doomsday, but that's the risk that cyber poses as we get more connected to the internet, more reliant on technology in everything we do. So that's kind of where we're headed. And what does this mean for the insurance markets? Other lines of coverage, right? The property insurance company at that German steel mill didn't think that a cyber event could do that, right? So they're starting to pull back, starting to add on exclusions for cyber. So if cyber causes property damage, it's excluded. So there's beginning to be a gap, and really that's what we're here for as brokers, is to fill in that gap. If that's a big concern, let's make sure we do something about it. Let's make sure we get a product in place, get creative, write the language for the product to fill in that gap for a client. And then really quickly here, I think we're at 1 o'clock, so I apologize. Really quickly here, so we have all that first party stuff I talked about, the fun stuff, the ransomware, if you will, all that type of stuff. But really what's also scaring underwriters, aside from the aggregation problem, is the privacy regulatory landscape. These new laws are coming out. They are making companies really, that might not think they have an exposure, really get compliant. These laws are very cumbersome, right? Like not even a breach. It has like CCPA, which is California Consumer Protection Act. It's a very long law that really, it's how you handle data. It's how you let consumers know, what are you doing with their data? Are you selling their data? Who's holding the data? The right to be deleted. And there's going to be more states that follow suit, right? That's just a few of the big name ones. They're GDPR in Europe, BIPA in Illinois. So more states are going to follow suit. They're, each one is different. They're all not the same. Makes you guys more valuable as privacy attorneys. So what does this mean for businesses? So compliance, getting fully compliant, or at least making the right strides to getting compliant with these laws is very cumbersome, a big undertaking for our clients. Data hygiene is a big issue with this. They don't know what data they have. They don't know where it's at. They don't know how much. They don't know how long they've had it, if they're supposed to have it. So these are really big issues for our clients. And then really keeping up with those changes, like I said here, with clients, something they have exposure to these laws, like we don't operate in Europe, we don't operate in California. It doesn't matter. Does the consumer that you have on your database, are they from California? Then you have an exposure, right? So, there's so much that goes into as far as like I said, data hygiene. Where is it stored? How long is it stored? Are you retaining it? So there's a lot of, outside of insurance, just a lot organizations have to do to keep up with this changing landscape. And then back to insurance, you're bringing it back here. So insurability, first, we're still navigating these laws, right? So is it insurable? And what that means is, okay, you get fined $50 million from the state of California as an organization. is the state of California going to allow insurance to indemnify you? The policies are written in a way that they will respond, but if it's not insurable by law, not much we can do there. And then some implications of these lawsuits, which, you know, think of it as you will, but so statutory damages. So in California, for example, you know, if there's a data breach, if they mishandled your data that led to, you know, the class action lawsuit, then the consumer whose data was misused, stolen, data theft, they don't have to prove financial loss in order to get, you know, compensation from that. So like I said, statutory damages, you know, it's between, I think, $500 and $750 per individual. So massive data breach, it's a big fine and penalty from the government. And then cyber market reaction. We've found that BIPA has been insurable if it's not egregious. So the market's going to react, right? You have a couple $10 million losses because of these lawsuits related to the regulatory laws. Then the market's going to react. They're going to pull back and they ask more questions. And then finally, you know, if they're uninsurable by law, there are offshore products through Bermuda that can wrap around your product. Basically, a punitive damages wrap that will indemnify the insured whenever you know, it's uninsurable by law. I don't necessarily actually know how it works. I don't know how they bring the money over when it's uninsurable by law, but those products are available. So you know, with that, like you said, you know, wrapping up, it's just a really quickly changing environment, fun space to be in. You know, how is the cyber insurance market going to be sustainable for the long term? Its premium is going to triple. You know, it's really just a moving target that we're staying on top of it, locked, and we have a lot of analytics tools, a lot of deep dive discussions about organizations that we're the broker for, about their operations, how they operate. So, you know, fun space to be in, and yeah, so I'll turn it back over to Chris here.
Thanks, Riley. That's all we have today in terms of D&O and cyber. If there are any questions, either on the computer, you have a few, or in the crowd.
I did have one. The question came in, are these market results the same for privately held companies?
I touched on that a little bit in one of the slides very quickly. It is the same, but not quite as severe. So we're seeing the private company insurers cutting back on limits as it relates to entity coverage and antitrust coverage. They're raising retentions and they're also raising prices, but it is certainly not at the same extreme as in the public space. Any other questions? Thank you all for your time.